Hello and welcome to our conversation today around dealing with concentrated stock positions. My name is Zach Ashburn. I'm the Chief Planning Officer at Reach Strategic Wealth. And this is an issue that we find comes up often for our clients. In one way or another, they're dealing with a concentrated stock position, and you might be as well. Once I was at the dentist, they were trying, as they tend to have a conversation with me while their hands were in my mouth. And they happened to ask what I did for a living, and their response after I told them was, "Well, I don't know what I own, but I know I am diversified," in the best North Carolina twang you could imagine. And it's besides being funny imagery of how this conversation played out, it's also insightful to our conversation today because how could you possibly know if you're diversified if you don't know what you own and you don't know your plan or how you got there? So we've got a few tips and tricks and resources for you to how to determine how to identify and manage your concentrated stock position. Diving right in, the first question we really should assess is it too much? What does that actually mean? So, for example, here, this is someone who has an appreciated position in Tesla. They've bought this stock and it's run up and it makes a fairly large percentage of their portfolio, a little over 14 in this example. And so we could look at our default assessment that is probably no individual position should make up more than 5% of your portfolio. And that's a reasonable rule of thumb for most people. It is, however, a rule of thumb. And when you look at the growth of a concentrated position, it's really easy to get lost in sort of the mental gymnastics around what does this mean for you? What does this mean for your family? What does it mean for your ability to continue to build wealth? What does it mean for your ability to preserve the wealth you have built? We hear this phrase often, concentration builds wealth, diversification keeps wealth. And there's some issues with that when it comes to, even if it's true in some senses, there's some issues when it comes to preserving and building your family's wealth and the risk that you're putting at along the way. And so it prompts us to probe deeper. What does too much really mean? So here's a few ideas as you plan your steps. When it comes to assessing, is it too much? Let's look at some questions that we might be able to ask to frame up this conversation a little bit. There's no bright line test for what too much means. Some say 2%. You saw our example of a default 5%. Some even say 10 or 20%, depending on where you're at in your plan. So we find it helpful to have this conversation with some of the surrounding factors to clear up what might represent too much for your personal plan. So would you be okay even if this position tanked? If it truly went to zero, what would that mean for your family? Would you be derailed completely and starting from scratch? Would you be disappointed but okay? Would it make a difference to your balance sheet, but not really a difference to how you're going to live your life in the next phase of things? So this gives us just a quick litmus test for how damaging would it really be. Is the stock serving any other purpose? Is it part of a philanthropic or legacy plan? Or is there anything else surrounding why you own it other than that it has happened to run up and it makes up a significant part of your portfolio? How volatile is it? There's going to be differences depending on the type of position that you have in the amount of risk that you're going to have to your plan. That might be not be the primary concern, but it's worth considering. I'm expecting big swings out of this, or I'm not. Would you buy it today? Tends to be the most clarifying question. If you have an appreciated stock position, if I gave you the equivalent amount in cash today and you'd say, well, no, I would never buy it today. Well, that's a good cue to consider how are we going to divest that position in one way or another, because it's not something you're interested in owning at today's price, except that you already happen to. Is your salary tied to this company? This would be for our friends that are paid in stock options or equity compensation. If your salary or your income is tied to the same company that you own a lot of stock of, you are increasing your risk to your family. Because if that company falls on hard times, your stock likely will go down, but it's also increases your risk that you're subject to a layoff or other employment changes. So we want to take that into consideration with how you proceed. And lastly, are you building out other parts of your portfolio or your financial situation? Are you investing in real estate and you're diversifying in other asset classes? Are you building out your portfolio more broadly? These are cues. These are helpful mental frameworks to consider how comfortable you really are with the position that you have. It's very helpful to trace how we get here. How do we arrive at this concentrated position? Because different ways of getting here will likely dictate different ways of dealing with it. So a common scenario we find is someone has inherited an appreciated stock position. You've got a lump sum in your portfolio because you received it from somebody else. Maybe they worked for that company, or maybe they had it run up, but you've now received it. And if you've inherited it, you may have different options or different things you'd like to consider as you move your own path forward. You may have simply made a really good investment, and you may have put that money to work and it's run up, and now you're left with these big built-in gains that you have to figure out how to deal with. So you've got this tax component along with the maybe nervousness around the size of the position itself. And lastly, if you get paid in stock options or in equity, it's not uncommon at all that you amass that over time. Maybe you're prohibited from selling it, or maybe you simply haven't. Maybe you like the company you work for and you've held on to it, but now you've reached this breaking point where you say, "Oh, this is actually putting us at risk as a family, and we need to have some strategy on how we're going to deal with it." These are all possible paths for how you've arrived in this scenario with this concentrated stock position. And I think that it's helpful to separate that from the fact of from however you choose to deal with that position. And that's because not only might it inform what you want to do as your path forward, it separates the two different problems. Acknowledging we've got a concentrated stock position and we got there through this set of events, series of events, is different from, and now we're choosing a path forward on how to deal with it. So we want to take those two steps to be sure along the way that we want to act on this rather than only accepting the rules of thumb, for example. So we'll transition now to a few ideas on what to do if you choose to begin managing this concentrated stock position. So our first option is to go die. this is this is simply the best path forward in most respects for how to deal with a concentrated stock position. And I say that a little bit jokingly, but it's also actually true. When you pass away with a concentrated stock position, as you pass that to your beneficiaries, it's going to receive a step up in cost basis. So in our short little example here, if T marks the date that you bought this stock or received this stock and it was at $50 a share, and you've owned it for 20 years and it's now at 200, if you were to sell it today, you're going to pay capital gains tax on that. However, if you were to pass away and pass it along to your heirs, that would they would receive this step up in basis, and it would be like they paid $200 a share for it. So if they chose to sell it, then they would be able to do so without gains. So while it's a little bit funny of a suggestion, there's actually good room for how do we treat this as part of your legacy and charitable planning along the way. And so, as you're considering your estate plan, you might be on the other side of how you received concentrated stock. Did you inherit it and have the opportunity to sell some without significant tax implications to your family? This is the other side where you might be able to pass it along to pass along a more tax advantage way to deal with it to the next generation. You can refer to your planning packet for a walkthrough of what assets are likely to receive a step up in basis and how that works. There's a flow chart guide for you in that planning packet. So moving along with our next possible way to deal with concentrated stock position, you can give it. And this is one of the most common ways that we can build around a plan for managing concentrated stock later in life. If you're charitably inclined, you get to you have the opportunity to shift that potential tax bill that you would have to a nonprofit by gifting appreciated stock positions. And we find this mistake happen sometimes where someone will sell stock and then give cash to a charity, versus you might, in this scenario, wish you had just given the stock and not incurred that tax bill. We're going to use this example here of a donor advised fund, which may be a slightly higher leverage way to do the same operation. Many charities will just accept your concentrated stock or a portion of your concentrated stock anyway as a donation. Using a donor advised fund may be a little more advantageous for your family's plans, and there's a walkthrough of how a donor advised fund works in your planning packet. But for our purposes today, the high level overview is that you could potentially gift your concentrated stock position, receive an upfront deduction that you can then divest, sell, and reallocate those funds, and then parcel them out over time. Give your money, your investments, time to grow along the way, and then make donations year over year as you choose to. So It is easier. There's ways to not only donate, but if even some more private or complex assets might be able to be used to be tackled this way. Having one receipt to deal with, we've made one donation to the donor advised fund is simply simpler than making direct contributions to multiple charities. You can do this anonymously, is also helpful. But the key point is that contributions to a donor advised fund allow you to gift this appreciated stock without having to sell it and incur the taxes on your own. This needs to be part of a thoughtful plan, just like any giving strategy would. And so this is one example of how that could work. But what you can do is not only assess how helpful is it to get that out of your portfolio without the risk of the volatility of that concentrated position, but also what will the tax impact be? So when we model this for folks, we look side by side and say, if you go with a contribution to a donor advised fund, what is that going to be like? And if you don't, what is that going to be like? And you can make that choice. You're welcome to do whatever you'd like to do, but you can actually see the impact. And again, with this question of concentrated stock, we're talking about this twofold impact of hopefully an improvement in your portfolio and your diversification, but also potential tax advantages along the way if you're charitably inclined already. The next option for how to manage concentrated stock is to hedge it. And the most likely way you would go about hedging a position is with stock options. So we'll use this quick example that you've got your stock, however you arrived at having this position, and we'll say that it's got its price chart here. It's going to go up, it's going to go down. And maybe you've bought it here where we have our little map pin. And you say, I understand that in holding this position, it's going to have swings up and down, but it now makes up a lot of my portfolio. Or because I worked there, it's a really large amount of my portfolio. So I'm not really comfortable with the big swings down. I'd really like to cushion it or establish a floor or a safety net along the way. And options allow you to do that. You're able to say, I'm comfortable with some swings down, but I'm going to draw this line right here, and that's really where I'd like to hedge, to cap my risk along the way. Now, in doing so, you're going to incur some costs. To set up a strategy like this will have some cost around the options you'll have to buy to put this strategy together. And so that's one note that makes this questionable. Do you want to incur that cost and the sort of sophistication around having to complete that strategy? You do have the option as you create this strategy to also cap your upside by selling other contracts and recouping some of the money that you have had to outlay to have your downside protection. So you can both buy and sell options to create different strategies in how you'd like to construct these bounds that you want the price targets to stay in. It's doable. It's one option. It hedges your risk. It says, I'm okay with owning this position. I just don't want all of the volatility, and I've constructed a way to make that how it shows up in my portfolio. It's also worth noting you can sort of, depending on the contracts available and in the market, you can customize this. You could say, I want it to be at this level. I want it to be less volatility, or I'm comfortable with more. And you have the ability to do that with option strategies. There are a number of reasons it also might not be the appropriate path forward for you. One of the biggest ones we run into is for employees of companies who are being paid in equity. They may not be allowed to at all trade in derivatives around their company stock. That may be prohibited and is commonly prohibited in their employment agreement as they're given shares. So it's sometimes just not an option from that perspective. It also might be complex. It also might be that you would rather be looking at other routes forward so that you don't and find yourself ongoing having to maintain an option strategy. Usually this would be a temporary position to truly hedge a risk for a time. Or it would be a significant position you're not able to divest from for one reason or another, and you just want to safeguard the investment itself. So that's one route you could go to deal with the position itself by hedging it. Another, and a perhaps more intriguing one, would be to diversify it. There's a number of things that you could refer to this as. We'll use the term completion fund, but what we would find is instead of hedging using option strategies, you invest in other things. So you take your stock and you surround it by building out your portfolio. And then you are far less concerned with the movements of any one holding that you might have, because on average, over time, you've constructed a portfolio that you expect works for your goals. You could do this in two ways. You could do this by slowly over time trimming down your concentrated stock position and using the proceeds to buy other positions. Or you could, if you're still working or you have other income, hold your concentrated stock position or hedge it for a time while you invest the new money you're making into these satellite positions to round out your portfolio. And then over time, you are minimizing the impact of your currently concentrated stock position by investing in other things. So there's a few ways technically that can look. A common one would be direct indexing, where you buy a wide range of things, but you remove the concentrated position that you have so you don't buy any more of it. But suffice it to say, it needs to be a thoughtful strategy to build that portfolio to achieve the diversification you want. So you may elect to do something where you don't own that stock, or you don't own that industry, or you buy it broadly enough that you have a globally diversified portfolio kind of at the end of your strategy. So you could hedge your position. You can diversify it with a completion fund. You could potentially give away your stock or portion of your stock. You could die. That's again still an option. And then our last option is to sell it. How do you go about selling it in a way that's thoughtful for your family's goals? So here's an example of managing your capital gains brackets. Your capital gains brackets are calculated differently beside your ordinary income tax brackets. And so we want to be thoughtful when it comes to, I'm going to start selling stocks and incurring these long-term capital gains. Is there a way that we can do that and take advantage of lower brackets? So an example would be you're a high earner this year, but you're about to retire. So your income goes from significant to zero. Well, as you can see, at up to 89,000 in this example, this was a 2023 analysis, but up to $89,000, if you're married, you could sell a significant portion of stock and incur 0% capital gains. And so that really simplified example gives us the ability to look at and say, are there thoughtful ways we can time income, time the sales of the stock that you have, and be able to lower your effective capital gains rate? Not for nothing, we're also in historically fairly low capital gains brackets. So when it comes to, should I hold on to this stock? I've acknowledged it's concentrated, but should I hold on to it? It's very, very reasonable to consider I can lock in the capital gains rate I pay this year by selling it, or over the next few years, whatever your thoughtful strategy is. But the point is that selling your position should always be considered as an option. You never want the fear of a tax bill to expose you to the risk of unknown moves in the market. And so while you can maybe accept that, it's not easy to say, I'm going to pay the tax bill. I know that, but we can be thoughtful about it by managing your capital gains brackets over time. And it turns out that as we make these assessments on, do we really believe that we have a position that represents a concentrated risk, a position that is quote unquote too much. And then we move into considering how did we get here and what is really our plan for dealing with it? What are these specific actions we want to take, these routes to be able to deal with it? It turns out that the result of doing that is the thing we would call a financial plan. And we're able to kind of put all those moves in the context of your life to say, does this work out well? Are we likely to succeed at the goals that we want to achieve? And if we like that result, what are the things that we should be doing this year, next year, and so on to achieve that? What are the cash flows in our family likely to look like if we take those actions? And the result of that being a financial plan is how you're able to time your actions well, time your actions specific, or make your actions specific to the goals that you want to achieve. Thank you so much for joining us for this conversation. You're welcome to reach out to us anytime. Please refer to your planning packet for additional resources, and we look forward to talking to you again soon.